There's a lot of information out there in regards to housing and mortgage rates and so forth. So I figured I'd start sharing my weekly newsletter that I receive with you each month. We spend a lot of money on all this data, and I thought I would share it with you because there's a lot of videos out there that kind of go through things and brush it with a wide stroke. But I want to really focus in on markets and what's going on with housing, what's going on with rates, and then also why. So this should be very useful for realtors, people in the mortgage industry, as well as consumers. So, one of the biggest questions I get a lot is, is it a good time to buy? Should I buy? What's going to go on with housing? Is there going to be a housing crash? So based on the information I'll start sharing with you guys, it's going to give you hopefully some backdrop on why we should not see a housing crash. And why housing sales are doing what they're doing. So let's start out first by commentary from, I subscribe to Black Knight. I'm not sure if you can get this on your own unless you're a paid subscriber, but instead of paying to subscribe, just add to my channel or subscribe to my channel and you can find out a lot of information. So what's in the works right now is in Congress or in the government, there's the legislation for the infrastructure bill. That's kind of falling by the wayside right now. So that might spur in some things with the economy pushing up inflation because the government's going to start printing even more money. So we'll worry about inflation when the Fed starts to worry about inflation. But I'll give you highlights on what's going on with that. But what we want to focus in on right now is where bond markets are, and then because that's the component of mortgage rates, and then the housing market, what it's doing. And then I'm also going to start sharing through the week, pockets in the country that are doing very well and some that are not doing as well. So right now we see the 10-year, it's trading at a 1.58, and that's the 10-year Treasury bond. And I focus, if you follow my channel every day, I bring up this number, but I mainly focus on the mortgage-backed securities market. But in here, we're gonna talk about everything. So you're going to see down through here, there's a bunch of different numbers, but we'll come back up to here one more time, and you're going to see housing starts in April came in lower than expected as input prices jumped due to supply bottlenecks, while existing home sales and new sales both dropped as housing supplies remain at very low levels. As related to the inventory shortage, Case-Shiller index increased 13.27% year over year versus the 12.5 expected. Pending home sales are due out today. They haven't come out yet, as well as personal income and other data that's coming out on Friday. So let me put this in context for you a little bit. This is saying basically the average mortgage rate on a 30-year term is 3.15. Housing starts are down because when they referenced the bottleneck, there was a bottleneck in the Panama Canal not too long ago between that and other supply chains that made it really difficult to get stuff to build homes. So that's why you saw building or new constructions drop the way they did. Plus you saw prices in lumber basically triple over the past year, and that's driving up prices to build homes. So a lot of people right now are contemplating, do I hold off until that subsides a little bit? That's a valid argument. Now, when it comes to existing home sales, they're down because there's just no inventory. My backdrop on the inventory, let me get rid of this chart real quick. My backdrop on the inventory is this. And it's validated. I validated with our CEO today, as well as other people that I talk with, is there's 1.8 million people in forbearance. Okay, what is forbearance? For those that don't know, that don't have a mortgage, or that do have a mortgage and never did it, forbearance basically is back last March of 2020. The government and the banks kind of got together and they said we got to figure out a way to help homeowners through this pandemic. So they came up with a plan that would allow you to basically postpone, and I'll put that in air quotes, postpone your mortgage payment. And it was put in place from March to supposedly March. It was first what was proposed that you could skip or postpone 6 mortgage payments. Then it came out that it was going to be for a year. So we were looking from March to March. Okay. Then in March, there was 1.8 million people. There's still 1.6 million people in this forbearance program, but some people did come out of forbearance. And again, the forbearance basically means that you do not have to make that month's mortgage payment. You're not skipping it. It's getting added somewhere, or you're going to have to catch it up. But they pushed that off, and now what they did is they were pushing it off to June of this year, and now it might even be pushed off till September of this year. So that basically means a lot of homeowners, or 1.8 million homeowners, haven't had to make a mortgage payment in a year and a half, year and 3/4. So think about it. If you're not making a mortgage payment, even if you're working, if you want to sell your house, what would happen? Well, you sell your house that you're not making a mortgage payment on, and you got to rent or buy another house that you'll have to make a mortgage payment on. Why would you put your house up for sale? Okay, so there's 1.8 million people in that predicament. Then you have a ton of people that are unemployed that can't even get a mortgage if they wanted to buy a house. So between those two, that's why we have such existing home sales are not there, because nobody's moving in that situation. Yes, you can capitalize on if you could sell right now, and if it's a seller's market, it's usually a seller's market. What we're trying to do at the Frio team is we're trying to help you guys get qualified for a mortgage and basically get you completely approved. So when you place an offer in on a home, you're basically looked upon as a cash buyer, because we can close in as little as 2 to 3 weeks. Okay, so that's that part of it. But let's get back to my data, and this is going to be the first video on this. I'm also going to post this on Patreon, because this is basically what my Patreon page is going to be for, is these in-depth videos that you can go to and actually find training videos. So let's get back to the charts that we're looking at. Now down through here, you're seeing market indicators. Then you have benchmarks one week ago, current, and delta. Delta means change, okay? And what this means, I'll break it down. This means the FN means Fannie Mae, current, CPN means coupon, okay? So let's not really focus in on that in detail, what this number is. Let's just look at what the direction is going in. So every day when I post on my videos, I basically post what's going on with MBS, mortgage-backed securities, and what happened for that day, and what direction are we taking. Okay, so we're going to focus in on right here. But what we want to do is see where we were 1 week ago. We were at 122.30 seconds. So for you, that might be like, well, okay, that's really nothing. But let me put it in perspective. Currently, we're at 101 and 5/30 seconds. So this means we were up 15-30 seconds. And what this is right here is what's happening to the price of the bond. As the price goes up, so it meant over the last week, the Fannie Mae 2 coupon is on a 30, or Fannie 30-20 coupon, and I'll explain that in a little more detail here in a second, is up 15-30 seconds. That's good, because as the price goes up, rates come down. Okay, this video is going to be basically the weekly update version 1, or 101, meaning it's our training video. So I'm going to introduce you to a lot of concepts here. All right, so we have a FN30, which means Fannie Mae 30-year 2.0 coupon. Okay, I won't explain the 2.0 coupon in this video, but you can see it's a Fannie 30, a Fannie 15, so the 15-year term. Ginnie Mae means government-backed loans on a 30, and then over here we'll just keep this aside. This is basically what the rate is doing, okay? So we start out here, and again, you can see each one of these is up. This is up 15-30 seconds. That's good news. This is up 8-30 seconds. This is up 5-30 seconds. So all that is good news for mortgage rates, because as the price goes up, rates come down. Overall, in the past week, we've seen rates go down 0.01. Okay, let me explain how rates truly work in the real world. Rates go in increments of eighths. So in this case, it would be 3.125 is how it would calculate out in the real world, but we want to be really precise and show you guys where it's at every click of the way. So it might be a little complicated, but when we're done with this, all of it's going to tie together. So basically, we saw mortgage-backed security prices across the board going up and rates come down, just a tick. Not much, but it's a good direction. I'd rather have that doing that than going up, okay? So let's scroll down for some additional data. This is going through what's happening with different variations of yields. So the overnight LIBOR, and none of these really affect mortgage rates. These are just Treasury yields or LIBOR rates. LIBOR is what a lot of adjustable rates are tied to. Okay, so we got the LIBOR rate, the 2-year Treasury yield, 10-year, 30-year, and the spread between the 10 and 30. All right, and I'm going to introduce you to these concepts, and on a weekly basis, we're going to dig in a little bit more deeper in areas that I feel would be more relative to you. So the LIBOR is down 0.003 over the last week, so virtually nothing. And you can basically go across the board. It's not really any variance, especially when you're rounding down to 0.00 something. That is completely irrelevant, I'll say, in the real world, because you're not going to see a difference in a yield of 0.004 versus 0.003. Okay, but this is what's going on with the LIBOR and the Treasury yields. Now we're going to move down through and see what's happening in the real world when it comes to home sales. Okay, this should be in the wheelhouse to a lot of you realtors out there, as well as you mortgage people, and also so people out there looking to buy or maybe sell their home. So new home sales, where are they actually? Well, in April, there was 863 new home sales. The expectation was 970, so 158,000 less than was expected. All right, in March, we had the actual was 1.021 million. The expected was 868, and that was much better than expected. I hope I said that right over here in April. We actually had 860,000. Yes, I did. Expected was 970, and that was 158,000 less. February. So March was a great month. I think a lot of people just finally. This might even fall into my category where people fell out of the forbearance in March. So like I got to start making my mortgage payment. So I'll go ahead and move into maybe a bigger house, a smaller house, a different state or something. So that's what I contribute a lot of this in March too. We might see it again in June and again in September. February, 775,000 was actual, expected 875, 148,000 less. Okay, so 1 year moving average, 24,000 more than we expected. Okay, so those are those charts right there. And again, this is factual data from Black Knight, one of the largest analytical companies in the country. All right, so that's the economic data. Best effort, we're not going to go through that. That's basically just for mortgage people. And then we're going to get some news here. And I'm going to include this in the description down below that you can actually download it from there. I'm saving it onto a outside drive, and you can grab this down below, and you'll be able to do that on a weekly basis. So the Fed, the biggest question asked to the Fed is, are you going to plan on tightening anytime soon? And don't foresee us doing anything. And why? We just don't think it's that time to do it right now. The economy is, yes, it's starting to uptick, but we just don't think it's long. We're going to monitor it over a longer term to see if where things take us. So let me just read it. We're not quite there yet. I think we will get there in the months ahead. I think there will come a time when we can talk more about changing the parameters of the monetary policy. I don't think we should do it at this time, still in the pandemic. And that's basically what they're saying is they have no plans on doing anything right now about tapering or increasing rates. When I mentioned tapering, what the Fed does is they go in and they buy up mortgage-backed securities, which is a bond that is the biggest component of your mortgage rate, and they buy it up. Meaning they buy a lot of it to keep the yields down, because when you have supply and demand, the higher the demand, and the Federal Reserve is putting it there, the lower the lower the yields are going to go. Okay, let's read this one as too. A number of participants suggest that if the economy continues to make rapid progress toward the committee's goals, it might be appropriate at some point in the upcoming meetings to begin discussing a plan for adjusting the pace of the asset purchases. And again, that's when the Fed's stepping in and they're buying up bonds. They're buying up corporate bonds as well as mortgage-backed securities to kind of subside or keep a lid on what's going on with rates, mortgage rates, as well as rates throughout the economy. Weekly tip is in response to recent guidance by the FHFA. That's basically the Fannie Mae and Freddie Mac, they do 90% of the country's mortgages and agencies. OBS now has an on-demand high-risk loan monitoring report by OBSS. I'm trying to get access to this so I can show you guys what the average loan-to-value, debt ratio, FICO score, and a whole bunch of other things are on mortgages at this time. The economic calendar for this week was, and basically all this is virtually over at this point other than Friday's news. And a lot of this data came in. Let's go to another screen and I'll tell you where some of this data came in. So every day I go and do a report, and this is what the actually video looks like a little bit. We use this chart right here to figure out what's going on with mortgage-backed securities. This is what I meant by mortgage-backed securities. It's a bond that trades on Wall Street that is the biggest component of your mortgage rate. Okay, as this number goes down, which I just discussed, when you pay less for a bond, that means the yield or your mortgage rate goes up. Here's how this works. In Mortgages or Bonds 101, when you have a bond, let's say you have a bond that matures next year for $100, okay? So it's $100 next year when you turn in your piece of paper, you turn in your coupon, and you get $100 back. So how much did we pay for that coupon? Well, let's say, for example, today we bought it for $100. So I gave you $100 for this coupon, and in a year, I get $100 back. What was my rate of return? I gave you 100 and I got 100 back. It's 0. So what that means is your mortgage rate would be 0. It's never going to happen, okay? But this is just for demonstration purposes. Now let's say I pay less, so the price goes down, so you can understand what I'm getting my concept is. Let's say I pay $50 for that coupon. So I give you $50 today. I hand in my coupon next year and I get $100. What's my rate of return? 100%. I doubled my money. So in that case, my yield or my mortgage rate would be 100%. So you see how if the price goes down, the yield goes up. That's basically how Bonds 101 works. All right, so that's that component of this equation. But what we're looking at today is what happened with my economic calendar. And I'm going to go there and I'm going to show you the economic calendar, what happened today's numbers. And you're going to see why mortgage-backed securities dropped and yields went up. Okay, personal spending. Let's see what happened there. I'm sorry, I'm on Fridays. Durable goods orders. Durable goods orders was previous was 1.3, was supposed to come in at 0.8. It was minus 1.3. Not a good day for durable goods. Durable goods X transportation. So we pull out transportation into that, and it's 1. So it's better than consensus, but it's worse than where we were last week. Now we get into the sweet spot of the Fed. What's jobless claims doing? Initial jobless claims, meaning how many people initially brand new file claims. Well, last month we had 478,000. The consensus was 425. We only had 406,000. That was good news or better news for the markets. So the stock market went up. Okay. Continued jobless claims, another area that we like the progression where we're getting there. Previously, we had 3,738,000. This the consensus was at first 3.68, and we actually came in at 3.64, a little bit better. So we're getting better in that area. GDP annualized, where are we? We're at 6.4, right in line to where everybody thought we were going to be. GB purchasing index, pending home sales. Let's see where we are there. And we already know that number's down because there's just no homes available. Previously was 1.7 million. Consensus was to be at 0.8. We were negative 4.4. So don't get freaked out over that number. Again, why is it doing that? There's just no homes for sale. Why? A lot of people are just staying put where they are. Okay? So that's that part of it. And then tomorrow we have personal income coming out like we just went over. The forecast is minus 14, consumer spending, core inflation, and the trade deficit. There's really nothing here except for core inflation that's going to come out that the Fed watches. So I don't really think anything is going to happen tomorrow. But what we see today isn't good news, but I'll take it. Being down minus 16, we're below what my forecast is. I thought we were going to hold tight right here on the 25-day moving average. That was going to create a floor for us. The day isn't over yet, so my hope is that we close above this line right here. Okay, so let me explain this charting for you. You're going to run across here and you're going to see some numbers and some colors. You have a 200 DMA, which means day moving average. So we have a 200-day moving average, 100-day moving average, 50-day, 25-day, and basically where we're at. Okay, so there's also a lot of additional numbers in here, and let's get rid of this so I can show you those additional numbers. So we take out all of those, you're left with a couple lines that go across here like this. And these are what we call Fibonacci levels. So anybody, if you took economics, statistics, or anything, you know what Fibonacci is. Basically, they create ceilings and floors when you're charting. So why is this one relevant? You know, down here, why would you say, well, where does this come into play? Well, it was a floor or a ceiling at one time, and it was back in this area here, which was back in the end of March. Okay, but just think of these lines as bumpers when you're bowling. Okay, when you're bowling, you put up bumpers, and what happens is you throw the ball and it bounces all over the place, but it stays within these parameters or where you place the bumpers. That's basically what Fibonacci levels are intended to do. They're saying, okay, this should be an artificial ceiling and or floor for when numbers are trading or when things trade. So any charts that you do, you can chart the temperature, you can chart stock prices, whatever. It's going to fall in a range similar to this. Okay, so we keep hitting this chart here, or this Fibonacci level, and we close above it every once in a while, and then we pull right back down. We close above, pull down. So it's there. And that's basically the line that I'm focusing on right now. This Fibonacci line right here, the ceiling, it's just there because of this little blip in the radar here and right here. But I'm using right now, we should be falling between these two right here. Okay, so let's now bring in some more numbers. Okay, so now I plugged in the 25-day moving average. So if you charted out all these numbers and plotted it, this is what you would get. So this also creates resistance levels, and my hope and my thought is it's going to create a short-term barrier right now that I'm hoping that we close above that today. Okay, here's why. If we start to deteriorate from this, now we broke that resistance level. The next resistance level is going to be down here. So we could fall from here to here. Okay, so let me put this in a nutshell. Remember, as these prices fall, the rates go up. So we don't want this to fall. And if we do, we want kind of some safety nets in place that can help us or resist the fall. So that's what we focus in on here. And that's why I chart these things on a daily basis, and that's why a lot of people follow me, is we chart, I give you the patterns that we're working on right now. And then what we also do is we dig in on the economic data that's also will affect and does affect this number. And then we also go in and look at it in a microscope on what it did for the day. And why we do that is what actually happened during that day. You can see we started out okay, and then all of a sudden right around 11:45 or noon, there was a drop. What I'm thinking in this is basically, you know, the data didn't come out all that bad. What I think a lot of people are going to do, just being honest right now, is there's a lot of people probably going to take tomorrow off. And this is a bond that trades on Wall Street. So a lot of people are just going to sell out of their position, go away for the weekend, and come back on Tuesday and start trading again. So they dump their positions. And that's why we probably saw a dump here. So that's basically, you know, the new newsletter that I'm going to come out with each Thursday to give you a recap of where we are through the week, and then what my predictions are for next week. But I think that's enough for now. This is a new format that we're going to be doing on Thursdays to educate realtors, mortgage people, mortgage advisors, as well as the consumers out there that are looking to maybe buy or sell their homes and figure out, is this really a good time to buy or sell, or should I wait? My analogy on a lot of that is right now, if you can buy a house, God bless you. I wouldn't overpay for anything. We're seeing a lot of people right now getting into contracts, and they're doing nut things. They're putting in there saying, whatever the house appraises for, I'll buy it. Guys, please don't jump down that rabbit hole, because when the market stabilizes, I'm not going to say the market's going to take a turn and values are going to start to plummet, but please don't spend too much. Don't get too excited over a house and spend way beyond your means to buy a house. I get it where you want to buy a house. Look around. Eventually, there's going to be a house that comes in that fits your wheelhouse, and you'll be able to get into it. I always say there's a reason for everything, so take that for some education. But hopefully you find value in this video. Please give me a thumbs up, subscribe down below, hit the bell, so every time I post a video you get an alert. I know it's a lengthy video, but my goal is to educate you guys out there, realtors, financial planners, mortgage advisors, and especially those consumers out there that they don't know what to do, and it's a big investment. So thanks for watching, guys. God bless. Take care. I'll see you next time. Bye-bye.